Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So as we all know, today is Tuesday, so we are almost headed to the New York Open. So we'll be trying to understand what has been currently happening in the markets and what we are looking forward to. So today has been quite a crazy day. Since morning, we have seen a lot of volatility from Australian dollar pairs, and this is as a result of the morning news, where we basically focused on interest rate data. So the Reserve Bank of Australia went for a 25 basis point hike, which pushed their interest rates to 3.60%. So the market reacted by basically pricing in a bigger inflation, or basically saying that the central bank is not doing enough to control the rising inflation that has been a problem since last year. So with that in mind, today I want us to deviate a little bit and try to understand what has been happening in the US sector. So I want us to focus on the data that we saw last month. And once we get to visualize this data, we understand what Jerome Powell is currently looking at. So we know that today, later in the evening, we will be having a speech by Fed Chair Jerome Powell. And in this speech, markets are waiting to see what he says, whether he has changed his policy stance. And once we understand that, then we'll be able to be aligned with the market and where it's headed. So it's a very important session for us today. And once we go through the data, then we'll identify where potential opportunities may lie. So the speech is set to start at 6 p.m. And in this speech, he'll be looking to testify about semi-annual monetary policy report, and this will be before the Senate Banking Committee. So the last time he did this was in June, and the comments he issued basically led to a very big change in market perspective, where we continued seeing a very strong and healthy dollar, and at the same time, we continued seeing equities weakening for the rest of the year. So there is a good chance that whatever outlook he presents the Senate Banking Committee might have a big impact on the continuing trends that we'll be expecting for the quarter and perhaps right into the next quarter. So if you have any questions or comments, feel free to type that in the live comment section, and these will confirm that this will help drive the conversation. I'll be responding to that right away. So hello Trapskid, and thank you for joining the session. Let's get on with it. So let's start by first looking at what happened to the dollar. And in this case, use the benchmark dollar index. So since the beginning of last month, we can see there was a huge shift. So this is literally where the dollar index started trading in February. Immediately on the very first day of trading, there was a sharp drop, and then the following day a recovery, and then on the third day of trading, the dollar index turned to the positive side. So this eventually led to a continued push higher and higher, where the dollar index continued strengthening, basically indicating that the dollar was strengthening against its peers. So we saw the dollar strengthening against the pound, against the euro, against the Canadian dollar, and most importantly, against the Japanese yen, where we have seen a huge divergence in the policy, where one central bank is aggressively hiking interest rates, whereas the other one is maintaining rates at negative 0.1%. And then on the other hand, one central bank reduced all its quantitative easing programs to zero, whereas Japan continues to print more money and use it to normalize the bond rates at plus or minus 0.5%. So as a result, we have seen a huge divergence between the two economies, leading to a clear direction in the exchange rates. So as the dollar index continues strengthening, you can see a big shift this month. So today being the 7th of March, The dollar index started on Monday last week by dropping and then making a recovery, then rallied all the way up and then ended the week here. This was Thursday. Friday pulled back, so ended the week here. So yesterday, there was a continued push downwards, which did not hold as much. Since today, the dollar started out strongly and has been strong for the entire session. So far, we are seeing a very healthy and strong dollar. Right from the opening of the day, we had a couple of 3 candlesticks down. Then the next 3 candlesticks recovered, and from then it has been a bullish story for the dollar index. So now that you understand that the dollar has been up, dropped slightly this month, made a recovery, a drop, and now seems to be recovering again, let's look at the background story and what has been causing this movement. So the movement has been caused by a couple of factors. So I'll be jumping right away. And let's start with the economic calendar. So in the economic calendar, I want us to take a trip back. I know it's very common that whenever we are doing these sessions, we normally focus on last week, this week, next week. But this time, I want us to take a trip all the way back to the beginning of February. So we look at the January data before we jump to February data. So in January, we saw a couple of things happening. Employment cost index was up 1.0%, meaning a steady growth, but not as fast as last year. Housing prices were down 0.1%. We saw Chicago PMI at 44.3, basically indicating a contraction in the state. CB consumer confidence was at 100.7.1, which was a drop from 109 previously. Then we had the major news in the early week, beginning with the ADP non-farm employment change, which was at 106K compared to 253K the previous month. So final manufacturing PMI and ISM manufacturing PMI also are below standard. Remember, if this data is at 50.0 or higher, indicates expansion. If it's below, then it's contraction. So job openings are at 11.01 million. Compared to 10.44 million in December. Then we proceeded and got a 25 basis point hike. And this was on the first day of the month of February, where interest rates moved from 4.5% to 4.75%. So later on, we saw the jobs data, and this was the big surprising movement that led to a change in perspectives in the markets, where the markets were largely expecting a rise of 193K jobs in January, but then the big data came in at 517K. So this was one of the biggest surprises that we have seen this year, with the US creating a very large number of jobs in its economy. On top of that, unemployment dropped from 3.5% to 3.4% versus an expectation of 3.6%. And this was a record 54-year low in the job sector. So ISM services PMI showed an expansion immediately, and also final services PMI a little bit of improvement, but not yet in the expansion territory. So fast forward to the following week, we had a speech from Fed Chair Powell, where he maintained that they are still looking to hike rates higher and keep them high for longer. So we had a couple of FOMC members speaking, such as Barr and Williams, as well as Kashkari. Then later on, we had Waller speaking, and then we looked at the consumer sentiment, which was much higher than expected at 66.4. Then inflation expectations went higher to 4.2% from the previous number of 3.9%. Fast forward the third week, then we saw the inflation data. So inflation data came in at higher than expected, 0.5%. So a lot of people were expecting that inflation would come in slower than expected, especially considering that in the previous month, it was a deflationary reading of negative 0.1%. And this was the first time since 2020 around, this was April, May, and June. So for a majority of this period since COVID, we have seen consumer price inflation rise higher and higher. And as interest rate hikes started taking effect, this number went down and kept going down. And in the most recent speech by Fed Chair Powell, he had mentioned that the US economy had entered a deflationary environment. So a deflationary environment is where prices now start going down. That's why we had a negative 0.1 reading. So after seeing the negative 0.1 reading, the Fed basically said it was a deflationary environment, and they narrowed their rate hikes from 50 basis points down to 25 basis points. However, following this big jump in inflation of 0.5%, and this was in January, now things are about to change, especially when we now combine with the issue of number of jobs created rising and also wage growth are remaining pretty strong. So core inflation, which is basically a measure of inflation without volatile food and energy prices, also rose from 0.3% to 0.4%, indicating that inflation had not dropped for the month, but rather it had increased. And this is a new challenge for the Fed. So core retail sales came in on Wednesday, the 15th of February. This was a big jump of 2.3% from a previous reading of negative 0.9%. So the number of retail purchases had dropped in the previous month of December, negative 0.9%. Then in January, there was a big spike, meaning that the consumer was very healthy and they were purchasing more retail products. Empire State Manufacturing Index was expected to basically contract further, but in this case, from negative 32.9 jumped to negative 5.8, indicating improving manufacturing conditions. So retail sales jumped 3%. So the first data was, core retail sales. Then going forward, we saw industrial production move to 0.0% from a negative 1.0%. So level almost getting into an expansion territory. Business inventories maintained the same at 0.3%. Then the housing market index basically improved from 35 to 42, indicating that housing is getting hotter. So in the case of housing, we know that interest rates were rising, that is mortgage interest rates, and they had hit a high of 7.5%, basically leading to sellers lowering their prices. And as they lowered their prices to attract more clients, then there was a spike in demand. So the housing market index was indicative of the same. Then we moved on to another key data point that the Fed normally looks at, and this is called producer price index. So the producer price index basically measures the change in the price of finished goods and services sold by producers. So also, this one experienced a big spike from negative 0.2% to a positive of 0.7%. So core PPI also jumped from 0.3 to 0.5%, basically raising worries that once these goods by producers get into the market and they get fed into the next inflation number, then we could be seeing much higher prices in the US, or basically indicating that we could be seeing some higher inflation on March. So remember, in March, we'll be looking at the data point for what happened in February. So Philadelphia Fed Manufacturing Index, this one did badly, negative 24.3 from the previous negative 8.9, but the unemployment claims are maintained well at 194K, which was lower than expected. You don't want unemployment claims to be rising. So building permits maintained level 1.34 million, whereas the housing starts slightly slowed down to 1.31. So going forward, then we moved to another week where we looked at flash services PMI, which moved into the expansion territory, 50.5 from a reading of 46.8. Flash manufacturing PMI jumped to 47.8, an improvement from about 6.9, but still slightly below expansion. Existing home sales were at 4 million compared to 4.03, not a big difference. Then we had the Fed meeting minutes where we saw that there was a couple of members that were in favor for continued rate hikes, and even some suggesting a 50 basis point hike. Then we looked at the GDP data quarter over quarter, which jumped 2.7%. Previous reading was 2.9%, basically indicating a slight slowdown in economic activity. Unemployment claims came in again. Remember, this is weekly. 192K compared to 200K, slightly below. Then we saw the GDP price index improving to 3.9% from 3.5. Before we looked at one of the most important data that the Fed looks at, and this is core PCE price index. So this is short for personal consumption expenditure, and it basically measures the change in the price of goods and services purchased by consumers, excluding food and energy. So it showed a big surprise, jumping from 0.4 to 0.6%, now raising inflation expectations higher. So on the next reading of inflation data, we might be expecting a bigger number. So personal income in the US jumped to 0.6% from the previous 0.3%, meaning it was rising, but still significantly below the target of the analyst estimate of 1%. So personal spending also rose to 1.8% from negative 0.1%, also indicating an increase in aggregate demand in the US, and this is considered to be inflationary. So new home sales, as you can see, jumped to 670K compared to 625K the previous month, indicating the effect of lowering house prices, which basically increases demand. Then UAM consumer sentiment jumped 67.0, and also revised UAM inflation expectations slowed down a little bit, 4.1 from 4.2% the previous reading. And now, this leads us to another week where we had quite a number of news happening in the markets. Core durable goods orders, a big jump, 0.7%. So the way we tend to think about core durable goods orders is that whenever your income is slow and you are uncertain about future expectations of the economy, then you stick to buying only the basics. So you buy food, you buy healthcare, you buy transport, you pay your energy bills, you pay for education and all that. But you retain from buying a new car, you retain from replacing your furniture or electronics. But then if the economy is good, your income is working well, and you are hopeful that you'll be able to sustain your current level of income in the near future, then in that case, you consider purchasing what you call durable goods. So in this case, seeing a big jump in core durable goods orders was an indication that the American consumer is still very healthy and expanding their consumption. In this case, a big jump from negative 0.2% to positive 0.7%. So durable goods orders, in this case, dropped negative 4.5%, but then pending home sales increased by 8.1%. So a couple of speeches by FOMC member Jefferson, as well as Goolsbee and Kashkari. Then we also saw the CB consumer confidence data slowing down a little bit to 102.9 from 106.0. Then we had the ISM manufacturing PMI, which read 47.7. Final manufacturing PMI 47.3. And when you look at the services sector, I think it was the one that was having a big expansion, while manufacturing was only improving slightly, but not yet at expansion. So as we approach the end of the week, we saw our final services PMI jump to 50.6, and also ISM PMI at 55.1, basically indicating expansion. Then this leads to the current week. So in this current week, we saw factory orders jump lower to negative 1.6% compared to a positive 1.7% the previous month. So This week, the most important news for the day is Fed Chair Powell's speech at 6 p.m. But then we'll be having a set of other news happening. Remember, the Fed Chair will be testifying again tomorrow. But the most important news for the week will be the jobs data. So since seeing the 517K jobs the previous month, now analysts expect that the US created 224K jobs in the month of February. So the outcome on Friday will be compared with this expectation. If it's higher than this, then that's positive for the economy. Then if it's lower than this, then it's negative for the economy. Unemployment rate is expected to remain level at 3.4%. So now, as we head into the speech by Fed Chair Jerome Powell, we know a couple of things that have been happening over the past 1 month. There was a spike in inflation. There was a spike in PCE price index. At the same time, retail sales went higher. A little bit of improvement in manufacturing, but a big rise in services sector. Wages made a big jump higher. And these all factors, when you combine them together, they basically paint a picture of an economy that is so resilient and an economy that is facing an acute hot job market. So an acute hot job market basically means that the economy is expanding at a faster rate than the number of jobs being created. So any American right now who is looking for a job, we already find a job, and companies are the ones that are struggling to hire talent. So in this case, whenever you have such an economic environment, then you expect that a majority of American workers are currently employed and they have good incomes because companies are competing for them. So they are going forward by raising wages. I remember seeing these in the earnings of Target as well as Walmart. Basically, from the earnings call, the two companies indicating that they are increasing wages in order to retain talent. So higher wages mean that people have more purchasing power and they have the effect of pushing prices higher. Whenever you have too much money flowing in the economy, chasing after fewer goods, then this basically leads to higher inflation. So now that we understand what we are facing, then the other key thing to consider is how the Fed might react and how the markets will react to what the Fed will do. So we know that Jerome Powell will be issuing a speech later today at 6 p.m. And there will be questions about the same data that we have just seen today. So the very expectation is that the Fed maintains the current pace. Remember, the Fed is being careful not to overheat or not to over-tighten the economy. So over-tightening basically means raising interest rates so high that they eventually cause or lead the economy into a recession. So the way this happens is that high interest rates will eventually make credit card debt very expensive. It will make mortgage payments very expensive, and people will be left with less money to honor their debts. So in that case, less money to spend in the economy. And in that case, companies within the US find themselves selling less products, firing people because the sales have gone down. And in that case, the economy eventually gets into a recession. So the Fed doesn't want to slow down the economy until it gets into a recession. So in so doing, since they already implemented several rate hikes last year, and this year we already have one rate hike of 25 basis points, so they might want to consider making small incremental rate hikes going through this quarter and the next, and observing how the economy responds to that. However, if there's a big jump in factors that increase inflation, then in that case, we could be seeing the Fed reacting by making stronger rate hikes, perhaps 50 basis points. So as per now, the expectation is that the market will go for a 25 basis point hike. So if you look at investing.com, they usually have a very nice indicator of our expectations. I think it should be somewhere here, if I'm not wrong. So I don't know if it's investing.com or FX Street. Just confirming this quickly. So it's one of them. Just want to make sure I have the data quickly. I think it should be under their tools. Yeah, the Fed rate monitor tool. Got it. So I can share this with you right away. So I'm seeing a challenge here. Someone was mentioning that the sound is has an issue, but another one mentioned that it's clear. So if you have a challenge with sound, kindly try using headphones. On my side, I believe that my audio settings are at maximum. So let's get back to this. So from investing.com, what we are looking at is the Fed rate monitor tool. The Fed rate monitor tool calculator is based on CME Group 30-day Fed futures prices, which tend to signal the market's expectations regarding the possibility of changes to US interest rates based on Fed monetary policy. The tool allows users to calculate the likelihood of an upcoming Fed rate hike or cut. So the next meeting is on March 22nd, 2023, and there are two considerations here. So the first consideration is that the Fed goes for a 50 basis point hike that will move interest rates to 5.25%. And the other one is a 25 basis point hike that will move interest rates to 5%. So there is a likelihood that of about 70.1% that the Fed goes for a 25 basis point hike, and a 29.9% likelihood that it will go for a 50 basis point hike. So now that we know that there are two outcomes here, we will be following the Fed Chair Powell's meeting closely to understand whether we should be betting on 50 or whether we should be betting on 25. So that's why a lot of investors will be trying to estimate whether he's hawkish enough or whether he remains dovish. Dovish would be 25 basis points and hawkish would be 50 basis points hike. So the reaction in the markets is expected to be as follows. One, if he's hawkish and promises to continue hiking interest rates, then the US dollar recovers and we see the dollar index rallying all the way back up and maybe even breaking this week's high. So this week's high is here. And remember, two data points. One, the speech from the Fed Chair Jerome Powell, and also the most important news for the week, which is the non-farm payrolls data. So if it's dovish, then we will be expecting to see the dollar index go back and retest the previous low. And it seems the previous low is somewhere around here. So with that in mind, the strength of the dollar could lead to these currencies reversing their original direction. In this case, a strong dollar would push the USD Swiss franc all the way back up and get to the previous high, or perhaps extend the leg even higher. But then if that doesn't happen, then we would be seeing the USD Swiss franc drop further back downwards, especially to today's low. So for New Zealand USD, you can see there was an attempt to break higher, which was met with resistance as investors bought more and more dollar. So a further strength in the dollar, we just read us straight to the previous low. And this is a price level that we witnessed 2 weeks ago at 0.61305. So similar case with the Euro USD. Euro USD has been largely on a bearish trend. You can see the trend here. So managed to break out of this formation, got to this resistance and got rejected and went back down to retest the breakout point. This was the breakout point. So now the market is just moving sideways between these two bands before we get the news that would either trigger a break below or even a break above. So I would be very considerate watching 1.06904 as a resistance and 1.06516 as a support to see whether the Euro USD breaks which band first. So as for Pound USD, you can see it's a sharp fall. So from what we are seeing here, it's a very level support level at 1.193, but then the resistance seems to be going down and down. So every time the market gets close to the upper trend line, faces resistance and drops further. So key price level to watch is 1.193 and whether the market breaks that level. And also this upper side around 1.20843. Then we move on to other assets. We have USD CAD trading in this sideways form of triangle. It has already broken this particular pattern and is now headed higher. So from what we are seeing here, if you were to use a smaller time frame, such as the 15 minutes chart, you will see from Friday's swing and then Monday and then going into Tuesday, it's almost as if the market broke a triangle. This would be the triangle and is headed higher. So if you use the H1 chart, then you know that the most important price action level to observe is the resistance here that was faced here and also here and here. And this is a price level of 1.36538. So this is our key price level to observe. A break above, we go up, a bounce, we go back downwards. So for USDN, I remember analyzing this early in the morning. These long tails towards the lower side are completely indicative of a strong rejection of lower prices and an attempt to push prices higher. So since this morning, we have seen the USDN recover and you could see it getting back into pattern. So potentially from the 4-hour chart, we could be seeing the price move higher to the previous high. And this is a 137.1. So we could be seeing the USD yen continue to rally higher. So clearly, since the beginning of the year, we have seen the USD continue losing to the yen, hit a bottom, and then break a very important pattern that was holding true for quite a period of time. And this is from October last year. So from October last year, we have seen the USD yen trading along this particular channel before it broke towards the upper side. And this was relatively around January. So the entirety of February, the market was going up. And now that we're in March, we're enjoying a much needed pullback. So remember, in a bull market, you don't want to buy the tops, you want to buy the pullbacks. So there is a good chance we'll be seeing another. And if, let's say I zoom out here, you notice that the last leg moved this way. So if you get something similar, then even a price target of 138.09 might be in the books. So as for gold, you can see it was largely bearish, then bottomed around here. And then for the entire month of February, gold was largely bullish. Now that we are seeing this free fall happening in the price of gold, if the Fed chair is very aggressive, then a nice target for gold will be all the way down to the previous low, and this is around 1806. However, if there's a reversal, then a key price level to observe would be just the previous high or yesterday's high of around 1857. So AUDUSD was perhaps the most surprising asset to trade today, since after raising rates this morning by 25 basis points, the market challenged that, and we have seen this particular pattern show us that we had what looks like a cup and a handle, and now we have a confirmed break. So with this break, as I mentioned, this is an inverted cup and handle. So we might be expecting some further downside from this momentum or from this activity. So some further downside may be tested around this area here, which was a previous support level. So we could be seeing price continue dropping down to 0.66254. US equity indices are currently facing a very big challenge breaking this resistance. So you can see the resistance right here for the S&P 500. And since then, the market is seemingly trying to form a head and shoulder pattern. The first shoulder here, the head, and the second shoulder. So if we see strong bearish momentum during the New York session, then it might be confirmation that we are going back down. And as I mentioned earlier in the morning, there is a chance we'll be seeing the formation of a Burj Khalifa kind of pattern. So same case for US 30 and US Tech 100. Often you notice there is a very strong correlation between the three. And then when you look at Brent oil, we managed to find a very strong resistance here. And this was in the morning. And since then, the price of Brent oil has been moving further back downwards towards the previous low. And an obvious short-term or intraday target seems to be yesterday's low. And this is at a price level of about 84.356. So FTSE 100 is now retesting another area that we have been observing as a major resistance. So this trend line holds through despite this slight break before the market got back into pattern. So this will be a key price level to watch to see whether the FTSE breaks 79.63. So a break higher, we keep going, but if there's a rejection here, then we look for short selling trades. So that's it for today. And thank you very much, everyone, for your time and your participation. And I hope to see you guys on the next session. So where can we watch Powell's speech? I'll be looking for a link. So if I happen to see the link, then I'll be sharing with you guys. So unfortunately, I won't be live. So I can share my personal link to my personal Telegram group. And once you join the community, if I happen to have the link, then I'll be sharing that link with you guys directly. So there is the link, and I hope to see you guys on the next session. So remember, we have the market snapshot series happening Monday to Thursday at 11 a.m. So see you tomorrow at 11 a.m.